What is a credit score, how it works, and what you need to do to have a good score. Alright, folks, let's dive into something that sounds a bit daunting but is oh so important: credit scores. If you're scratching your head, wondering why this number matters, you're not alone. We've all been there. But trust me, it's crucial to get a grip on this because it's gonna follow you around for a while. So, what's a credit score, and how does it work? And more importantly, how can we make sure it's a good one? Understanding the basics of credit scores. First things first, a credit score is like a report card for adults. Yep, you heard it right. It's a number that tells lenders how trustworthy you are with borrowed money. Now, these scores usually range from 300 to 850. The higher the score, the better. Think of it as your financial GPA. It's calculated based on things like how well you pay your bills, how much debt you have, and how long you've been using credit. Credit scores are essential because they provide a quick, standardized way for lenders to determine the risk of lending you money. This risk assessment affects not only whether you are approved for a loan or credit card, but also the interest rates you'll be offered. Higher credit scores generally translate to lower interest rates, which can save you significant money over time when financing major purchases like a home or car. How credit scores work. So, how do these scores actually work? Basically, they're calculated using information from your credit report. Companies known as credit bureaus gather your financial data and use it to give you a score. The score is determined by several factors, including your payment history, amounts owed, length of credit history, new credit, and types of credit used. Your payment history is perhaps the most critical factor, accounting for about 35% of your score. This includes not only whether you pay your bills on time, but also whether you've ever missed payments or had accounts sent to collections. The amounts owed, or credit utilization, makes up 30% and considers how much of your available credit you're using. It's generally recommended to keep your credit utilization below 30% to maintain a healthy score. The length of your credit history counts for 15% of your score. This factor looks at how long your credit accounts have been active, including the age of your oldest account and the average age of all your accounts. New credit, or the number of recently opened accounts and hard inquiries, makes up 10% of your score. Finally, the types of credit used, which account for the remaining 10%, consider the variety of credit accounts you have, such as credit cards, mortgages, and installment loans. Why a good credit score matters. Now, why should you care about having a good credit score? Well, a high score can save you a ton of money. Seriously. It can get you lower interest rates on loans and credit cards, meaning you pay less over time. Plus, it can even affect your ability to rent an apartment or get a cell phone plan. Crazy, right? Moreover, some employers even check credit scores as part of the hiring process. While your credit score doesn't paint a complete picture of your financial situation, it can be used as an indicator of your reliability and responsibility. A good credit score can also come in handy in emergencies. If you need a loan quickly, having a strong credit score can speed up the approval process, giving you access to funds when you need them most. Steps to improve your credit score. Okay, so how do we get that score up? Here are some tips. 1. Pay your bills on time. This one's a no-brainer. Late payments can really ding your score, so set up reminders or automate payments if you have to. 2. Keep your credit card balances low. Try not to use more than 30% of your credit limit. This shows lenders that you're using credit responsibly. 3. Don't close old accounts even if you're not using them. Keep them open. They can help lengthen your credit history. 4. Only apply for credit when necessary. Every time you apply for credit, it can lower your score a bit. So, don't go overboard. 5. Diversify your credit mix. Having a mix of credit types, such as credit cards, mortgage, and installment loans, can positively affect your score. It shows lenders that you can manage different types of credit responsibly. 6. Regularly check your credit report. Mistakes on your credit report can drag down your score. By checking your report regularly, you can catch errors and dispute them before they cause long-term damage. 7. Pay down credit card balances. If you have high balances, work on paying them down as quickly as possible. This not only improves your credit utilization rate, but also reduces the interest you pay over time. Our personal experience with credit scores. Let's be real, we've had our share of credit score nightmares. There was a time when I forgot about a small medical bill. By the time I remembered, it had been sent to collections. Ouch. It took a while to fix, but I learned the importance of keeping an eye on my credit report. Trust me, checking it regularly can save you from a lot of headaches. Another instance involved a friend who, despite paying all her credit card bills on time, had a surprisingly low credit score. After some investigation, she discovered that a credit card she thought she closed years ago was still active, with a small annual fee she wasn't aware of, leading to a delinquent account mark. This taught us both the importance of following up on credit account closures and monitoring all accounts regularly. So, there you have it. Your credit score is a powerful tool in your financial toolkit. It's not just a number, it's your financial reputation. Take care of it, and it will take care of you. And remember, it's never too late to start improving it. FAQs. What is a good credit score range? Generally, a good credit score is considered to be 700 or above, but the higher, the better. How often should I check my credit score? It's a good idea to check your credit score at least once a year, or more frequently if you're planning a big purchase like a home. Can I improve my credit score quickly? Improving your credit score can take time, but paying bills on time and reducing debt can speed up the process. Does checking my credit score hurt it? No, checking your own credit score does not affect it. In fact, it's encouraged to keep track of your score to catch any errors or unexpected changes. Why did my credit score drop suddenly? It could be due to a missed payment, high credit utilization, or a new hard inquiry on your credit report. Sometimes, closing an old account can also affect your score by shortening your credit history. How can I dispute errors on my credit report? If you find an error on your credit report, you can dispute it with the credit bureau that issued the report. Provide documentation supporting your claim, and the bureau will investigate the error. If the investigation finds the error legitimate, it will be corrected, and your credit score may improve as a result. Remember, managing your credit score is an ongoing process. It requires diligence and responsibility, but the benefits of maintaining a good score far outweigh the effort. With a solid understanding of how credit scores work and a strategic approach to managing your credit, you can enjoy the financial advantages that come with an excellent score.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.